You're listening to the Limitless Wealth Method podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
What's up, everyone? This is Jason Hilliard. Welcome back to the Limitless Wealth Method podcast. My effort to share the ideas, strategies, and insights that help entrepreneurs, executives, and investors build wealth and live without limits. If you're getting value from this, it would mean the world to me if you would subscribe on your favorite platform, watch episodes on YouTube, and share it with just one person in your network who'd get something out of it. My goal is simple: help you grow your wealth and your life one episode at a time. Let's get into it. Right now, we're in one of those environments where nothing feels stable. Markets are moving fast, data is coming in mixed, and depending on the day, the exact same narrative can flip completely. One day you feel right, the next day you feel completely off. And in environments like this, a lot of people start asking the same question. If I'm right, why am I not seeing the outcome? Or worse, if I was so confident, why does this feel so wrong? And that's where this gets interesting, because most people assume that if they're right, things will work out. That's at least the underlying belief. If I make the right decision, if I see it correctly, if I understand what's happening, then eventually I'll win. But if that were actually true, more smart people would consistently win, and they don't. Here's the shift. Most people think outcomes come from being right, but in reality, outcomes come from being aligned with timing, and aligned with behavior. Now, before we go any further, we need to define something. When I say systems, I'm not talking about something abstract. I'm talking about the environments that determine outcomes. They could be markets or businesses or careers, any environments where there are rules, incentives, and feedback loops. That's a system. And every system has a way it distributes rewards. It could be money, opportunities, attention, trust. And here's the part most people miss. Systems don't reward correctness. They reward what they can recognize and reinforce. In environments like the one that we're in right now, high volatility, fast feedback, constant narrative shifts, they tend to expose this gap faster than anything else. Because when things are moving quickly, you feel the difference between being right and actually getting paid for it almost immediately. So if you're not aligned with how the system works, you can be right and still not get paid. There are two ways people get out of sync with systems. You're either too early or you're too inconsistent. One is a timing problem, the other is a behavioral problem. And both of them create that gap between being right and getting paid. Let's make this real. Let's take a look at Michael Burry during the housing bubble. He saw the collapse coming years before it happened. Not months, years. He dug into the underlying mortgage data, saw how fragile it was, and made a massive bet against the housing market. He was right, completely right. But here's what people forget. He was early, and being early came with a big cost. He had over $1 billion tied up in those positions. He was paying millions in premiums to hold those trades. Month after month, the market kept going up, which meant on paper, he looked wrong. His investors were furious. They were pulling money out of the fund. They were threatening lawsuits, questioning everything he was doing. At one point, he was down tens of millions of dollars, while knowing he was right. Think about that position for a second. You're right, but everything around you is telling you you're wrong. Your capital is tied up. Your credibility is under pressure. The feedback you're getting is negative. That's what being early actually feels like. Being right without reinforcement. And most people can't hold that. Not because they're wrong, but because the pressure forces them out before the system aligns. And when the housing market finally broke, he made over $700 million for his investors. Same idea, same position. The only difference was timing finally caught up. That's the cost of being early. It's not the idea, It's whether you can stay in position long enough to get paid. Now, there's an important distinction here because this is where people misinterpret the data or this idea, not the data. What made Michael Burry successful wasn't blind consistency. It wasn't just hold no matter what. That's not what happened. He wasn't rigid. He was consistent in conviction based on deep understanding. There's a difference there. Rigidity is holding something because you don't want to admit that you're wrong, ignoring new information, or staying stuck just to stay stuck. That's not strength. That's fragility. Consistency is different. Consistency is having a clear thesis, understanding what would invalidate it, and staying positioned as long as the thesis is still intact. That's what he did. He wasn't guessing. He'd gone deeper than almost anyone else in the underlying data. So while the market was moving against him, nothing in his core thesis had actually broken. The timing hadn't aligned yet, but the reasoning was still valid. So he stayed. So the lesson isn't just be consistent. The lesson is be consistent with something that's actually grounded and know the difference between being early and being wrong. Because consistency without understanding is just stubbornness. Consistency with understanding is what gets paid. There's a flip side to this, and I personally have experienced it firsthand. When I was an independent futures trader at the Chicago Board of Trade, I took a position short in the Dow Jones futures going into an unemployment number. I had done the work. I had a view on the data. I believed the number was going to come in worse than expected. And believe it or not, it did. The number came in weak, exactly how I anticipated. And the market went higher. Not down, it went higher. Because what I didn't fully appreciate at the time was that the information I was trading on was already priced in. The move had already happened. But I stayed in the position because in my mind, I was early. I thought the market just hasn't caught up yet. But that wasn't true. I wasn't early. I was missing something. And instead of reassessing that, I held. That ended up being the worst day I've ever had as a trader. And I walked out of the pit with a very clear lesson. I thought I was early, but I was actually wrong. The market wasn't wrong. My interpretation of it was. That's the difference. Being early means your thesis is right, but timing isn't aligned yet. Being wrong means the system is telling you something and you're not seeing it. And if you don't know the difference, consistency turns into stubbornness very quickly. Now, let's say you get the timing right, or it finally aligns. That still doesn't guarantee an outcome because systems don't care when you're right. They care how you behave consistently over time. Most systems reward consistency because consistency creates predictability, and predictability allows the system to respond. Markets reward repeatable behavior. Businesses reward reliability. Careers reward trust. When something is consistent, it becomes legible. It can be measured, trusted, reinforced. But intelligence often introduces variation. You adjust, you pivot, you rethink, which feels like optimization, but from the system's perspective, it can become noise. So you get people who are right, but not consistently rewarded. Here's the key. Systems don't reward being right once. They reward behavior they can depend on. Now, this is where the gap really shows up. If you're early and inconsistent, you don't get paid. You get ignored. If you're early but consistent, it's painful, but you stay in position so when timing aligns, you're still there. If you're late but consistent, you weren't first, but you're aligned and predictable, so the system rewards you quickly. If you're intelligent but inconsistent, you're right often, but nothing compounds, so you don't get paid consistently. So the real takeaway is this. You don't get paid for being right. You get paid for being right when the timing aligns and in a way the system can recognize. This is where people get stuck. Being early creates doubt. Being inconsistent creates instability. And the smarter you are, the easier it is to justify changing direction. So it feels like progress, but over time, it widens the gap between being right and getting paid. So how do you navigate this? Well, optionality. Optionality isn't about always being right. It's about staying in position long enough to get paid when you are. Can you withstand being early? Can you stay consistent long enough? Can you avoid being forced out before alignment happens? Because you don't control timing. You control whether you're still in the game when it shows up. So if you've been right, but not seeing the outcome, it doesn't automatically mean you're wrong. You might be early, you might be inconsistent, or you might not be aligned with how the system pays. Because at the end of the day, there is a gap between being right and getting paid. And closing that gap comes down to alignment. I appreciate you listening. And if you're still here, give us a follow on your favorite platform. Cheers.